I'm Andrew with Jesani Wealth Management. And within our multidimensional asset allocation strategy, one of the core components is private equity. And within that category, it can really be further broken down into two underlying categories. One, growth and buyout private equity. So that's when the private equity fund is investing in companies that are potentially distressed, that have room for improvement, essentially. They're taking a controlling interest, 50% or more, a lot of times 100% of the company, adding that value, actively managing the company, and then selling it at the end of the cycle, typically 5 to 8 years, for a higher valuation than they paid for it. And that could be selling it into the private market or selling it into the public market through an IPO. Venture capital is very, very different than buyout and growth private equity in that venture capital funds are seeking that unicorn, that 1 in 1,000 company that reaches $1 billion plus in revenues. But you hear about venture capital an awful lot because those are the investments where you see one venture capital investment succeeded and they made 4,000% return on the investment. But the fact really is that only about 97.5% of venture capital investments actually fail. So that leaves a success rate of about 2.5%. Now, it's also interesting that as far as new companies that are trying to establish themselves, only 0.05% of businesses actually even ever raise venture capital. So when you combine that and then the success ratio, it's pretty obvious that this is a very, very small sliver of the overall investment landscape, but nonetheless, it's a very exciting one because of the potential for ultra high returns. Now, typically, just as an example, let's say a venture capital fund has 10 different investments within a fund. It's not uncommon for 9 of those investments to go to zero, but one of those investments to generate a return significant enough that it cancels out the ones that went to zero and generates a significant return overall for the fund. Typically, they're aiming for 25 to 35% annual returns within a venture capital fund. So how is the cycle of venture capital investment? How does it actually go through and translate to the landscape? So here's a startup financing cycle spreadsheet where, of course, you have the red line being the revenue growth of the company. So you can see very early on, you have co-founders, they put their money in, they spend a bunch of money trying to get the company into the revenue stage. Very, very early on, you'll have angel investors, different than venture capital because angel investors are usually individual investors and they're not really advising the company. They don't get a board seat. It's usually just an investment, also known as seed capital. Now, you can see once the revenues start to gain traction, you'll see the first round or the A round of venture capital come in, followed by a second round. These are both considered early stage. Of course, early stage venture capital firms, this is the higher risk, but higher reward segment of the VC. There's also later stage venture capital funds. Some funds do both. Some funds specialize in a particular stage where they can create kind of a reoccurring probability of outcome. But then you have the third stage or the C round, and then sometimes a mezzanine financing. So all of this is considered venture capital, acquisition mergers, of course, strategic alliances. And all through this life cycle, the company can be doing equity crowdfunding in the private markets, and they certainly do that. Of course, the end goal in any type of private equity, especially venture capital, is for that company to reach the IPO stage where the valuations are much, much more favorable, particularly to the early investor, and then they'll typically sell out of that investment, depending on the situation, but there's usually an exit strategy somewhere around here. Now, the way that the fund is actually set up is quite similar to a real estate syndicate or a private equity buyout firm. you have the overall venture capital firm or the general partner. And under that umbrella, this is just showing one, but there certainly could be several different venture capital funds that all have a specific target market or a target type of company, whether it be where that company is in the growth stage or the sector of the market that that company's in. Now, within that venture capital fund, you'll have several different investments. It could be one, it could be 30, of course, depending on the fund. Some of the larger funds like Global Atlantic or Sequoia Capital, there's dozens and dozens of investments within each particular fund. Now, the ownership of the fund and the investors are called the limited partners. So you can see it's jointly owned by the general partner or the firm, as well as the limited partners. Now, even today, although a lot of investments have gotten much easier to access by retail investors, venture capital funds is still really not one of them. The majority of limited partners are going to be institutional investors like you see here, family offices, endowments, pension plans. And typically they pay a fee to the general partner, similar to a hedge fund, of a 2% management fee plus 20% of any profits that are generated from the overall fund or the investments in that fund. And one of the real differences between venture capital and for a seed investor would be that the venture capital fund does partner with the business, generate ideas, strategies to help grow that business. So it's well known that in the market landscape, it can be beneficial to the company to raise money through venture capital because you're going to gain them as a partner to help you successfully grow your company and get to the finish line or wherever it is that that particular company wants to go. Now, no surprise, still today, the vast majority of venture capital is raised in Silicon Valley. This number has gotten even higher. So California is far and away the number one state for venture capital. And then below that, you have New York, and then Boston, of course, Los Angeles would be part of California, but also Chicago, and more recently, Florida and Texas have gotten some venture capital fundraising as well. But this is the overall, 30,000 foot level picture of venture capital. There's many different funds out there. Again, for the retail investor, this is the most aggressive part of the portfolio. Even when we're talking about these institutional investors or limited partners, venture capital is typically a very, very, very small percentage of their overall investment portfolio, and certainly the most aggressive portion. It can be attractive, similar to how institutions look at it, as a very worthwhile investment for a small portion of any investor portfolio. So if you'd like to know more about any of the venture capital funds that we like right now in 2022, certainly reach out to me. My name's Andrew Constantinidis with Neil Jesani Wealth Management, and you can reach me at 954-800-8552. Okay, thank you.